Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Najwa binti Azizan 264792, and today I would like to answer all the questions that was given in the case study, which is case 5 Carribean Brewers. So the first question is, how can the majority shareholder shift wealth through accounting cost allocation and transfer pricing? So my answer is the majority shareholder can shift the wealth through accounting cost allocation and transfer pricing by influencing the decision on such factors. Transfer pricing refers to the price of goods or services that are exchanged between companies under common control. For instance, the price charged for the selling goods or services between a subsidiary company like Caribbean Brewers and its holding company, which is Gera International, is referred as the transfer price. On the other hand, the accounting cost allocation is a method of assigning costs related to the project. In the corporation setup, the majority shareholder in a company enjoys many rights when it comes to the decision making, as the individual or corporation is given the full control of the firm. That means that they can make a major decision regarding the operation and investment by the company. The processes such as the transfer pricing and the cost allocation would therefore be decided mainly by the majority shareholder. The other shareholders, which are the minority shareholder, will just participate in the voting process to approve a decision or reject it. In that perspective, the majority shareholder can shift the wealth by allocating more costs and also enabling the transfer pricing to be used by subsidiary to save on the cost. Okay, the next question is given the wording in figure 5 with respect to the taxation of related party transaction, to what extent is Caribbean Brewers vulnerable to tax reassessment? Okay, this is what's stated in figure 5, section 23, which is where a resident corporation carries on business with a non-resident corporation, and by reason of the relationship between such corporation, the cost of business between them has been arranged that the business done by resident produce less profit than those which could be expected to arise from that business if such relationship had no existence. Inland revenue may determine in a reasonable fashion whether any additional profit should be deemed to be accessible income of the resident corporation. Okay, so this is my analysis. First, the case study states that Caribbean Brewer is a tax resident of Antigua and thus subject to taxes of 30% of profit. And also, when preparing for the tax, we found out that all the export sales of Gera beer are made to Gera Caribbean, a wholly owned subsidiary of Gera International, which is located in a tax-free jurisdiction. This statement alone caused concern and a vulnerability to tax reassessment. Another major risk found in figure 4, which is Caribbean Brewers invoice Gera Caribbean but delivers them to the other island. Other than that, Caribbean Brewers is selling a case for $25 per case with no deposit for the exported Gera beer to Gera Caribbean. Then they also invoicing the cases to other island for $50 per case plus $8 per case deposit for the bottles. Thus, from an auditor perspective, this could be tax evasion. Therefore, in my point of view, Caribbean Brewer is too vulnerable to the tax reassessment. There are too many fraud happen here. In 2010, Gera reported taxable income of 8,317,512. So basically, with the 30% tax rate, that will be subject to a tax which is 2,495,254. Okay, and the last question is, what are the implications of the composition of the board members to the reporting of the CFO, assuming majority of the board is made up of representative of majority shareholders? Okay, so this is my answer. The implication of the composition of the board members to the reporting of the CFO is the impacts on the full disclosure requirement. Composition of the board determines how the major decision and approval are done by the company. The board often has the final say on many issues, including the financial reporting requirements from the corporation. The CFO, which is Chief Financial Officer, would have to listen and implement the decision that the board have agreed upon. The financial reporting and the disclosure of the company would therefore be approved by the board rather than the CFO. Therefore, it can greatly give impact on the full disclosure during the financial reporting by the CFO. Okay, that's all from me. Thank you.